Hi guys, thanks for making the time. I'm here to talk about how we did the first P2p derivative transaction with Blockstream. Before I get started, let me briefly introduce who I am. My name is Justin Dhingra. I'm the Chief Crypto Finance Officer at Crypto Garage. I have over 10 years of experience in derivatives, and I've recently pivoted into crypto. So you might be wondering who is Crypto Garage and what we do. Crypto Garage, we're a startup based in Tokyo, and we were established in September 2018. And we are a joint venture of 3 companies, Digital Garage, Tokyo Tanshi, and Blockstream. And what we do is we take the concepts of financial engineering and blockchain and integrate the two to create a P2P financial infrastructure that minimizes counterparty risk. So our role is we are a tech provider that takes the baseline tech and all the great work done on Bitcoin, sidechain, and the Lightning Network. And we apply advancements in smart contract technologies and cryptography. And our role is to take this financial architecture and create crypto finance products. So one product that we developed is, we called it P2p Derivatives. And in the spirit of this conference, the question is, what does free money mean to all of us? And in the context of P2P derivatives, what we're trying to do is, 1, minimize trust between 2 counterparties. Derivatives live in this world about taking counterparty risk and posting collateral for that. The second is minimize counterparty risk, and then third is more financial inclusions. Right now, derivatives is for a limited audience with big banks and financial trading companies. So what is P2P derivatives? So P2P derivatives is actually based on a academic idea that came from MIT Digital Currency Initiative. And this idea is called the Discrete log contract. It was proposed by a researcher named Thaddeus Dryja. And we took this concept further. And applied financial engineering concepts to build a practical use case for a financial instrument. So just as a refresher, what is a discrete log contract? So let me just walk you through what a discrete log contract is. It's a discrete log contract. It's when 2 parties agree on a contract on terms of the contract. And they use Bitcoin as collateral. So let's say we agree to buy Bitcoin at $10,000 1 week from now. So today, the 2 counterparties, they will post Bitcoin as collateral on the Bitcoin blockchain directly. We will lock that collateral on the blockchain. And then 1 week from now, we have an oracle that broadcasts a Bitcoin rate. And the blockchain will just be searching for that oracle and look at the price feed 1 week from now. And then the blockchain will just automatically distribute the collateral based on the winner and loser of that contract. So this entire flow is cryptographically secure using Bitcoin technology. And it's set up in a way where either counterparty cannot act illicitly. So this structure helps doing a derivative contract that minimizes counterparty risk. So we took the concept of a discrete log contract, and how do we apply financial engineering to it? So the first derivative we actually looked at is a forward contract. So just for everyone's basic knowledge, a forward contract is to buy or sell an asset at a predetermined price at a specific time. One of the technical challenges with a discrete log contract is you have to set a upper bound and lower bound. And in a forward contract, the counterparties can have unlimited profit and unlimited loss. So the twist that we added was to a forward contract, we set a upper bound and a lower bound to a forward contract, and we call it a collared forward contract. And now we have a defined payoff with an upper bound and lower bound, so we know how much collateral that both counterparty A and counterparty B should post. So we took this concept and we actually wanted to test out this transaction, and we have a good relationship with Blockstream. So we entered into a POC transaction with Blockstream, and there were a few things that we wanted to confirm about this idea. First, that a collared forward can act as a good proxy as a forward contract in a very short amount of time. We wanted to test the settlement process, make sure the collateral is secure on the blockchain, and then when we have an oracle that broadcasts the data feed, that the collateral is distributed automatically. And lastly, the whole concept of discrete log contract is the asset does not require a custodian. So we want to also prove that the collateral is secured without the need of a third party. So the kind of the specifics of the terms of the trade that we did with Blockstream, it was a 1-week forward contract. The notional was 1 BTC. Blockstream was naturally long BTC, and we took the other side to be short BTC. We agreed to fix the price to the spot price at that time, which was $5,250, and the upper bound, lower bound was set at plus and minus 20%. And on the trade day, both counterparties agreed to post collateral up front. So kind of the whole diagram, how it looks is we did the trade on April 9th. Both Blockstream and CryptoGarage, we posted 16 million Satoshi on day one. And a week later, that $5,250 ended up to be $5,030. So CryptoGarage had a net gain of about $200. And that net gain of $200 was automatically distributed on the settlement day of April 16th. So 1 week from now, the blockchain was just looking for the oracle feed and distributed the collateral automatically. So this was our test transaction. We were able to confirm the objectives that we were looking for. And then now we're at a stage to look for broader applications. So the one application we're thinking about is there a better way to sell Bitcoin rather than selling on a day-to-day basis? And you can actually use derivatives to sell Bitcoin at a higher price. So this is just an idea, but let's say Bitcoin's trading at $11,000 right now. We can actually engineer a derivative where you can lock in the Bitcoin price 10% higher than today's price, and using the kind of the idea of a discrete log contract, we were asking, let's say, a miner to lock in their Bitcoin for 1 month, and then 1 month from now, we can guarantee that 10% selling price. So it's just an idea that we're currently, speaking to the market players right now and see if they're interested in this idea. Just to sum up, what does free money mean in terms of P2p derivatives? One, I mentioned we want to minimize trust with collateral on the blockchain directly. We don't need a third-party custodian. We want to minimize counterparty risk. The counterparty risk is minimized because both counterparty A and counterparty B is posting their collateral up front. And then the audience for P2P derivatives is guys who are normally not trading derivatives. Our goal is we created this application where you can do a derivative trade with another counterparty. So we want to have derivatives to be a more financially inclusive environment. So as a kickoff to this conference, we actually published a Medium article about this transaction. It has a lot more details. I only have 10 minutes today, so I've only covered very high-level description. But you can find out more. If you're actually interested in trading a P2P derivative or adding more products to our lineup, please contact to this email. And lastly, we just want to give special thanks to the MIT Media Lab for thinking about the discrete log contract idea, and then finally Blockstream to be very supportive on our initiative. That's it for today, and thank you for your time.
And we actually have about 5 minutes left if anyone has any questions. All right, I'm coming to you.
Hi, thanks for that. Can you say again how you get the Oracle information? How you get the actual price data?
How do we get the price data?
Yeah.
We had a relationship with ICE, Intercontinental Exchange. They are an index provider for us, and we have an API data feed that's just broadcasting the BTC USD rate on a daily basis, and there's a signature attached to that price feed. And we just happened to use ICE because we had a close relationship. In the medium to long run, we're open to using multiple Oracle data sources.
Can this be done with or without Lightning Network? And what is the role that Lightning Network can play in financial derivatives?
So your question is, can this idea be used in the Lightning Network? Definitely, and it's something that's on our roadmap. So we first tested it on the Bitcoin main chain because some context about our company. We have 5 Bitcoin core developers in our company, so they were helping us with our smart contract initiatives. Where in our roadmap, we want to expand it to Lightning and also the sidechain liquid network that Blockstream is looking at. What was your other question?
What's the difference that Lightning Network can add if you build something of Lightning Network?
So I guess one thing that would be different in the Lightning Network is the Lightning nodes. They're already locking in Bitcoin in advance. In this setup, we have to ask the users to lock in their Bitcoin collateral up front. So the Lightning Network will remove one step in onboarding in this transaction.
Yeah,
Yes.
so great presentation. I'm super interested in DLCs as well. But the question I always have is like, how does an organic order book get created for something like this? Because obviously you need to match buyers and sellers for this derivative. Do you see that like developing OTC, or do you see some way that people match each other on a centralized platform, or what do you think about that process?
I see. So your question is, who will provide the liquidity of? Yeah. Yes. Yeah, so great question. That is a question that we do ask ourselves. It's kind of this chicken and egg situation. We have approached the crypto derivatives players, and they always think about capital. How can they be more capital efficient? This solution, you're required to put up capital up front. So they're a little bit reluctant, but at the same time, they're never going to say no to a trade. So our motivation is to find a new audience who wants to do a trustless derivative contract. So capture the demand first, and with the demand, find the supply. And that is our strategy right now.